Hello everyone, welcome to today's US Open live webinar. It is Thursday, September 7th, 10 minutes before Wall Street opens, our usual time slot. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. Well, it's again this, we live again in this bizarro world where good news is bad news for Wall Street and vice versa. We saw US equities reacting negatively to Wednesday's upbeat PMIs and today's data that showed another decline in jobless claims. On the other side of the Atlantic, we continue to see poor economic data from Eurozone, and we also had Bank of England, Governor Bailey giving a Dovish testimony in the Parliament yesterday, and of course the Bank of Canada held rates unchanged after 2 consecutive hikes. That's what we will be talking about today. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers, and then we'll move forward. Once again, please read carefully through the risk warnings and disclaimers, and we'll begin in a few seconds. Okay, let's get started. We have quite a lot of things to catch up on. We're gonna start with Euro USD, which we already have on our screens, and talk about the economic disparity between the two regions and the monetary policy differential. We're gonna then go to GBP USD and the dovish comments by BoE Governor Bailey. We're also gonna talk about the Bank of Canada, which held rates, and also the impact of this decision on the loonie. And then we're going to talk about the Nasdaq, and again how it reacts to the good economic results from the US, and round things off with what's ahead as always. So on the Euro USD front, we continue to see a fall as prospects for more hikes by the Fed remain alive, again due to resilient economy, and we're gonna talk a little bit more about it when we discuss the Nasdaq. And of course, the euro's rate advantage has eroded after President Lagarde opened the door to a pause, and we continue to see poor data. We had the bad PMIs recently, and now we got an anemic GDP growth of 0.1% Q-on-Q for Eurozone, which reinforces fears around the economy, and as such, it probably creates some apprehension around more hikes by the ECB. The technical outlook has not changed much based on from what we have been discussing over our previous sessions. It moves well below the pivotal 200 days exponential moving averages, and it is exposed to the key 1.0634, 1.0611 support. We're a bit cautious at this stage for further losses beyond that. We said again, we do feel that the US dollar strength, this US dollar strength is a bit exaggerated. In my view, it is maintained, of course, yet, and definitely the greenback has an advantage, but still I feel a bit there's a bit of an exaggeration there in the reaction to the data. Of course, markets are highly attuned to every piece of data, exactly because the central banks have touted the data dependence, and we're in transitional period in monetary policy. Now, the RSI, as you can see on the bottom part of the chart, continues to point to oversold conditions. And given the fact that the ECB could still deliver a hike next week, we can see an effort to reclaim the 200 days EMA by the euro, which is located at around 1.08. But as we said the other time, the upside looks unfriendly with multiple roadblocks on the way. Now let's move over to GBP USD. It is in a similar position due to the greenback strength, and we got yesterday Dovish comments by Governor Bailey, Governor of Bank of England, testifying in the Parliament. He said that the bank is much nearer now to the top of the cycle, and he clarified that he doesn't say that officers are at the top because they have one more meeting. So this to me looks like he's saying that okay, maybe we're gonna hike next time, but perhaps not after that. This is sort of what it sounds in my mind, at least, based on this wording. And of course, we've talked about it a lot. The ECB, the BoE is also in a tough spot. Inflation is coming down but remains elevated. Wages are at historic highs, wage growth, and that feeds this wage price inflation. And the economy is slowing, has very slow growth. Although it has performed better than expected, it's still very slow growth. So that keeps pressure for more tightening, but on the other hand, there are many risks. Now, as a result of Mr. Bailey's remarks, the British pound breaches a critical confluence of support, which we see now gives way on the chart. It is the 200 days EMA and the 50% Fibonacci of the 2022 low, 2023 high advance, and this brings 1.2307 in the spotlight. Once again, the move looks a bit stretched, as indicated by the RSI, and a recovery effort would be reasonable, but I struggle to see it tackling the 200 period EMA, the black line, at around 1.2680, 1.2690, and again, you can see an unhospitable upside. Now let's go to the loonie, the US dollar versus the Canadian dollar. You can see it's relatively stable over the past few sessions. Yesterday, we had the Bank of Canada keeping rates unchanged at 5% after 2 consecutive hikes, as it weighed on the economy's contraction by 0.2% Q-on-Q on the second quarter and a softening in labor conditions. On the other hand, wages remain elevated and inflation accelerated to 3.4% year over year in July. This keeps policymakers on edge, and they are concerned about the persistence of underlying price pressures. As such, they kept more tightening in play, stating their readiness to hike rates further if needed, making yesterday's decision essentially a hawkish hold. Now, USD CAD had a subdued reaction to the news, maintaining its bullish bias, and keeps the 2023 highs in its crosshairs, which is located at 1.3863. However, we see it showing some indecision this week, and of course, the Canadian dollar, being a commodity currency, is supported by the surge we have seen recently in oil prices, and we could definitely see correction here back towards the 200 period EMA at around 1.3480, 1.3490. That would be reasonable, but further losses have daily closes below it, and further losses have higher degree of difficulty. And once again, we're seeing how there are multiple support areas below the 200 period EMA. And now, as the US session kicks in, let's switch gear and head to the Nasdaq, the NAS 100. We said again that we're in this bizarre world where good news is bad news, and vice versa for Wall Street. Yesterday, we got ISM Services PMI upbeat, and an upbeat reading. And this sustains the higher for longer narrative for the Fed. And we also got another drop in jobless claims just earlier today, again feeding this narrative. We already said that markets are highly attuned to the economic releases. And there are also a few other factors in the background. We saw a report by the Wall Street Journal that Chinese government officials are banned from using Apple's iPhone, and that puts pressure on Apple's stock. And of course, this comes just days ahead of the new iPhone launch. And of course, China is a major market for Apple. Now, given all of the above, the index breaches the 200 days EMA. We had talked about how we could see a pullback to these levels, and now this could lead to further losses, and we see how there are multiple support levels there, starting from the 17,516 region roughly, where we got the 38% Fibonacci, which had been tested and defended before, and we also got the lower bound of the daily. It's more cloud, and of course more roadblocks further below. At this stage, we still expect the index to push for new 2023 highs at 15,946, but there may be scope for further correction and continuation of this move that we are seeing. But at this stage, we view this as limited. Now that's pretty much it. Let's round things off with what's ahead. Not many things, the truth is. We do expect some Fed speakers ahead of the communication blackout period, because we have in 2 weeks the policy decision. Over the weekend, we will get important inflation figures from China. The country grapples with deflation, and overall the post-pandemic economic recovery is sputtering there, so every piece of data is important there as well. And next week is a hot one, and the first big release is the UK employment data, very important for the Bank of England, because as we mentioned earlier, the wage aspect, pay growth has been historically high, and that doesn't help bring inflation down. So that's pretty much it from me. Thank you for joining. We will talk again next week on Tuesday at our usual time slot, 10 minutes before Wall Street opens.